Have you ever thought about leaving your job and becoming a full-time passive investor? On today's episode, we talked to Travis Watts. Travis left the oil sector as a W-2 employee, and he has become a limited partner in multiple syndications. Through his journey of being an LP, he got to know himself through self-education and the mistakes he made along the way. Travis discusses why he has chosen to become an LP in his deals and why you should always allocate a small percentage of your capital to other alternative assets. This is how you will be able to grow and gain knowledge as an investor. Tune in for Travis's tips for getting into a deal and the tax savings that can go along with it.
Hello, Travis. Welcome to the show. Let's get rolling by giving us a brief background about your investing experience and what assets you are in today.
All right, Joe. Thanks so much for having me. I'll give you kind of the medium background, not the long-winded one. I've been trying to condense it over time. So here's kind of my quick snapshot background. I got started in 2009 in single family homes, bought my first home when I was 20, house hacked that home, meaning I had a roommate who was effectively paying my mortgage. I was renting it out fully furnished in a college campus environment. And so that was kind of the light bulb of passive investing. I knew that this passive income thing really had something to it. If I was able to pull this off at an early age, what could I do, much later in life? So that's kind of what got the wheels turning. I ended up making that a full-time buy and hold rental. I did a whole bunch of strategies from fix and flips to vacation rentals to more house hacking. And I'd buy these homes distressed to live in myself, fix them up as fast as I could with the help of anybody who would help me and contractors, of course. And then, just rent out the bedrooms for a while. So I did this kind of very aggressive approach for many years as I worked in the oil field too. So I had a W-2 job, 14 hours a day, 98 hours a week, away from home. I was always either out of state or overseas. It was just a huge time commitment for me. And as you can probably imagine, it makes it pretty hard to scale a active real estate portfolio when that's kind of your day to day. So 2015 is where I burned out in the active single family space. And I thought, God, there's got to be another way to approach real estate. There's got to be a more hands-off approach to all of this. That's where I started really amplifying self-education, reading books, mentors, podcasts, networking, all this kind of stuff. And I learned about apartment syndications, private placement investing, limited partnerships, things where I could participate in a large asset, perhaps, a 300 unit apartment building, let's call it. And then I could just be a passive partner in that. And so it made it very scalable for me, whether I had one investment or 100, it was just hands off. And so from 2015 through today, that's all I do as far as investing are passive opportunities, all in the private placement space. I should say most in the private placement space.
And at what point did your investments allow you to leave your W-2 job?
Yeah, that was a fun moment. So I've always kept a budget since high school. So I always kind of knew the inflows and the outflows. What I never really sat down to calculate was net worth before. And so I'm sitting there at my oil field job, oil starting to tank. It was 2014, early 2015, somewhere in this time frame. And I'm thinking, I'm seeing the writing on the wall, right? What's next? Layoffs, what's next? I got to make a change. I just saw it coming. So I sat down and I thought, hey, what if I took all these single family homes, including the house that I lived in? What if I sold all of these, just went completely liquid, like a very extreme, bold move? And I paid the taxes and I paid the realtor commissions and I just got out of all this. What would I have in terms of a net worth? And then I thought, because again, I was just learning about syndications and what to expect in terms of cash flow and things like this. And I thought, okay, what if I took that net amount and put it all into these syndications? What kind of cash flow would I have? And as I ran those numbers, I realized I can leave my job. if I want to. And not only did I want to, I was probably going to have to. So that's what prompted me to pull the plug. And that was that moment that happened in 2015.
And so when you jumped from selling all your assets and you went into more of an LP or a limited partner role in syndications, is that correct?
That's right. Yeah. So about 80% of my investable portfolio still today even is in mostly value add B and C class apartment communities and either limited partnerships or LLC interests, things like that. And then 20% I allocate to kind of experimenting and keeping it fresh. You hear a lot of people say it in different ways. Mark Cuban says 10% Bitcoin. The point is you play around with a percentage of your portfolio, whether or not, you lose money or make money. So I've done a lot in that 20% category, and that kind of keeps it not so boring.
Well, I think also what's good about 20% category is that sometimes the opportunity on the 80% actually runs out, or the margin gets thinner over time. And so kind of testing those waters allows you to establish other relationships, other places that could allow you to start shifting 80% over there if things turn, right?
Yeah, you bet. Exactly. I don't want to be an expert in only one thing and one thing only. When that stops working, I got nothing. So.
No, I agree. And so, I know several people that are actually, in the process of selling their companies, or maybe they've already sold in the past, and they're looking to place their capital from, money they made when they exited the company sale. And when you go out into the space, there's hundreds and hundreds of opportunities across all different sectors of, private placements that get thrown at you.
Yeah.
When you start in 2015, you start looking at those avenues. How did you start filtering all the opportunities that were available to you out there?
That's a good point. I actually kind of had the opposite experience at first, which was I felt like there was no deals out there. And because I didn't know anybody in the space, I wasn't on these email lists. I wasn't, just thrown into this. I was crawling into it, with a tiny little peephole. So the first deals that I did were just with local operators. They were local to my area. But they weren't actually doing any deals locally. They were doing them in other states. And so for some reason, I don't know why to this day, but I felt like that was really important to partner up with somebody who's, essentially my neighbor. But, when you look at the odds, there's obviously some key players out there. What are the odds that's your neighbor? It's probably unlikely depending on where you live. But for me, that was the case. So these folks didn't have much experience or track record, threw some money at it, went higher and heavier than I should have on the investments, that I made. And then after about 6 to 12 months later, as I continued my education and networking, I realized, oh crap, those weren't the right people to invest with. There's to your point, there's thousands of opportunities out here and I didn't even know it. And so, you kind of had to crack the shell that way, so to speak. And so, yeah, I don't know, I've done a little over 30 private placement investments, but I think somewhere around 5 or 6 is where I was starting to kind of learn that. And I finally started writing down my criteria, what was important to me, and started focusing more on some key players at that point.
And so getting into that important criteria, what do you see as some of the most important factors that you use up front to determine if the syndication is worth being involved in?
Yeah, one thing I've learned going to conferences where there's, say, 1,000 people in the crowd and doing this over and over nationwide everywhere, what I've learned by networking with folks is everybody's got an opinion, everybody's got a bias, everybody's, thinks whatever they're doing is the best thing in the world. And there's nothing wrong with that. And if you're really great at whatever it is, self-storage or mobile home parks or office retail, whatever, that's great. But what's important is to define your own criteria. So what is it that you personally like, enjoy, understand, what makes sense to you, what aligns with your own core values, philosophy, all that kind of stuff. And then seek the operators in the space that are doing those types of deals. That's probably the biggest, most critical thing that I've learned. Because otherwise it's all noise, right? You go around and this person persuades you this is the right thing, and this person's into crypto, and then this person, and it's so confusing. And how would you know what to do? So you got to build a little bit of certainty and expertise in a niche to a point.
And I always like to say you don't ever see a pro forma that shows you losing money. Right?
Right. Yeah.
So what does it take, or is there any criteria that, you have to qualify in order to participate in these deals?
Yeah, it's a good point. So another is kind of the issue that I see with the regulations surrounding this space, in regard to the SEC stuff. So there's really two common types of offerings. There's a lot more than this, but two are 506B and 506C. Okay, 506B, short-handed here, means that you can't publicly advertise the deal. Okay, so someone's going to have to find you, you're going to have to find them, you're going to have to establish a relationship, you're going to have to discuss high level what you do, and then 30-day, whatever, down the road, you're going to say, hey, now I have a deal, whatever, do you remember me? And the 506Cs, you can publicly advertise. So those are the deals that you commonly see when you run an internet search. And this was the problem that I had, and that a lot of people have, especially if they're non-accredited investors. All you see pop up is 506Cs that say accredited investors only, meaning $1 million net worth, single or married, or 200,000 income if you're individual, 300 if you're married for the last couple of years, with expectations to do the same in the current year. As fast, hopefully I said that right. But anyway, so high net worth, high income folks, right? And a lot of people are nearing that threshold, or have never really considered that before, hadn't done what I do to, write down your net worth for the first time. And so you get this illusion that it's all for accredited investors out there. And if you're not one, then it's not something that you can do. But that's just not the case, because I would say the majority of deals I see now today are 506Bs. They can take on up to 35 sophisticated investors who may be non-accredited if they so choose to do so, the general partner or the sponsorship firm. So that's a little bit about the regulation, and a problem that I see a lot of people having is just the assumption that, well, I'm not accredited yet, so I'm not even going to look at this stuff or learn it, until I am, and might be a mistake.
I think another assumption some people might use is that they assume every pro forma is going to end up being show that on the back end of profitability, when they don't realize that some deals will actually, might not perform as anticipated.
Yeah, it's as unpredictable as choosing stocks, I guess, to draw a parallel or comparison. I mean, it's anybody's guess what the share of XYZ stock's going to do in 5 years. Now, I like to hope, well, based on my experience so far, I mean, it is more predictable than that when it comes to multifamily real estate. It's a slow moving, steady game where you have a lot of data to look back on, and there's not the volatility and the hype in the markets and the manipulation, all that kind of stuff. But yes, to your point, some deals I've done have exceeded pro forma in a very exceptional way. Others I have lost money in. Not in real estate though, but still it was a private placement deal I lost money in. And some just slightly underperform. Some do exactly what you might hope they would do, but it's all over the place. And you do have to realize it's a projection. So what are you really betting on? The team, the sponsorship group's ability to execute the business plan. And even if they have the track record, the experience, and the ability, there could be other outstanding factors with interest rates and political risk and floods, tornadoes, hurricanes. I mean, all of these things are out there in the world. And so even the best operators can't have a perfect track record. Something to think about.
So from your mistakes or some of the deals that might not have gone as well as expected, I mean, what are those things that people should keep an eye out for? Yeah,
back to kind of that 20%. Now, whether your philosophy is different, 10%, 5%, 1%, the experimental category, just be aware for the same thing that you're probably going to lose money now and again. That was my experience in that 20% category. I went pretty heavy on a deal that came out of an investment group I'm part of. And I did my due diligence for quite a while on the sponsor themselves and the fund. It was a fund structure. And what they did is they would buy distressed debt off the banks, and then they would try to collect on it. But the problem was, there's a lot of hands involved in this strategy. Okay, this wasn't just one operator and one group doing this with like a 20-year track record. This was like, well, hey, we know these folks in this state, and these guys help us in this state, and then this and this and so you couldn't possibly do all your due diligence accurately. It would take you a lifetime to get through all these people and all these books and everything. And long story short, I lost money because one of the operators in this whole thing ended up being a Ponzi scheme. So they had to allocate the total portion that was dedicated that direction to, it went into receivership, and it was just an immediate loss. And we've yet to see really anything of it. It's been a few years. So the point is, I guess, the takeaway, invest mostly in what makes sense to you. Again, back to your own criteria, your own core philosophy. That really didn't match up to much of what I really look at in the space. And so that was a hard lesson learned, but thankfully, just one so far.
So with today's environment and what's going on, in the economy, what are you looking at moving forward for the rest of this year or into next year? What type of deals? And
yeah, that's another, I spend my weeks just networking on the phone. I do these free 15-minute phone calls with folks, just a Q&A, right? Whether it was a blog or podcast or wherever somebody, found me or saw me. Everybody's got questions, or how does that pertain to my situation, or what about this situation? Anyway, so through doing that, I've another thing I've really learned, especially since COVID, is all the different thoughts and philosophies and points of view on COVID. I mean, you've got investors saying, oh, I'm out, I'm sitting on the sidelines till this whole thing's over, I'm not doing anything. You've got people saying, look, I just sold a business, I got to put some money to work, I don't want to sit on the sidelines for a year or two, or who knows how long. And then people in between, and you see the conservatives and you see the risk takers. And so for me, I tend to think I'm fairly conservative, moderately conservative. However, I've still continued to invest since March. Closed a deal in March, as an LP in that deal. And then 3 more since then, maybe 2 or 3 more since then. And I will continue to do so. I'm looking for deals this month. So the point is this, that the market has shifted, things have changed, collections and occupancy have swayed. Well, it's reflective in the purchase price of the properties that, I'm partnering on, right? Maybe there's a $2 million discount on the property or something like that on a larger multifamily. So that's my philosophy, is that there's always a deal to be had, whether we're in a bull market, whether we're in a bust, whether we're just stagnant for years. There's always going to be some deal that from an underwriting standpoint and being conservative makes sense. And so I'm of that mindset. But I know folks that have been on the sidelines almost 6 years now because they're waiting on the big crash. So I don't know.
So I guess like back in March when, the stock market was crashing, right? Everyone just decided to take a seat thinking that this thing was going to go down for a couple of years. And now we're back up, back to where it was. It's like crazy. So yeah, you don't know where the market's going. I mean, in theory, if interest rates are not going to move over the next couple of years, as the Fed is kind of giving us guidance,
right?
I mean, demand for real estate should stay strong. I mean, it's going to differ, be different in different areas, but it'll be interesting to see. And I'm glad to see you're still doing deals. I mean, we're doing deals ourselves and in specific areas that we think are still have room to grow over the next few years.
Yeah, exactly. And that's the other generalization that drives me nuts, is like when people just use a term like real estate. Well, real estate's going to go down. What does that mean? Single family, multifamily, self-storage, mobile home park, which markets, which sub-markets? What if you bought it at a 40% discount? Is that not a good deal? I mean, there's just so many factors. So it's real estate's local. That's the takeaway.
No, I agree there. And then, from, all the syndications you participated in, has there been any things that stuck out that, whether it's the software, the management used, or the strategy, anything that's worked better?
Well, I don't know. I mean, one thing I value as an LP is reporting, transparency, and communication. Well, I shouldn't say that. I guess that's 3 things, but all of that in one package. So I prefer personally, I mean, passive income is my income. So I like monthly frequency to reporting and distributions if possible. That's certainly not the industry norm, but I try to do a lot of deals that have that monthly communication and whatnot. Again, it's knowing yourself and just your personality. And I start to get a little stressed when 3 or 4 months go by and I haven't heard anything. And especially in an economic environment like we're in, or I'll give you an example. In 2019, I own a lot of properties out in Dallas, Fort Worth, and a tornado ripped right through the center of Dallas, Fort Worth. And it was really interesting that like half of the deals I was partnered in, they were like immediate on top, like, hey, this just happened, everything's okay, we're on the phone with the property management, it's all, and the other half are just like, we'll let you know when you know. And I don't appreciate that.
That's so, not good.
Yeah. So a little bit on that, but yeah, as far as like a specific, technology or something, not really. I like having,
I guess my question is more like, do you see an improvement in the returns to those operators that are more organized or had things more streamlined, or you've seen both sides?
That's a good point. And actually that's pretty true. So the more structured, the more detailed, the more thorough, the more communication, usually the better pulse they have on the investment itself versus the ones that maybe try to skirt away from it for a few months and then hurry up and make a report real fast. Kind of shows. So yeah, it's tough, man, because, you know, when you make an investment like this, you know enough to get rolling, you know enough to like or dislike these folks, but then 6 months, 12 months, 24 months is kind of a true test. You know, now you've kind of been through the ringer. And so I've partnered with over 14 operators at this point. I'm starting to kind of reel it back in a little bit.
Hey, that's top 5. That's like everything though in life, right? You go a little broad and then you find out what works the best, and then you put all your attention there, right?
Yeah, that's true. Yeah.
And what made you decide to take more of the LP route over the years and versus, you know, some kind of operator position on certain deals? And, you know, are you going to stick with that?
I get asked that a lot too.
Well, there's a lot of people probably listening. They're like, you know, I kind of want to do the deal myself, or I want to be an LP, or I'm not sure. And so why would someone choose one way or the other?
So since 2015, which is when I started doing this stuff on the passive side, there wasn't near the education that there is today. There weren't near the conferences, right? And the books and the webinars and seminars and all this kind of stuff. So to me, what happened was in my single family journey, I had a lot of self-reflection that was happening throughout, right? Each time I would try and do like a vacation rental or a flip, and then I would look back on the project and I would just realize I'm not that good. You know, there's people all around me doing this better, more efficiently, bigger profit margins, bigger teams, better connections. It's a lot of work, number one, a lot of time, a lot of work. And that's what I think a lot of folks don't realize when they think they go to like a weekend boot camp and then they come out on Monday and go, I'm going to go raise 10 million bucks and do a deal. You don't realize how much work it is and that it takes so much of this, you know, the connections and the education. So for me, my thought process was, hey, why don't I just piggyback off the success of those doing it best? Why don't I find people who are passionate about what they do, who have a track record, experience, things to show for it? Why don't I just partner with them? They obviously can do it better than I can do it. And yeah, they're going to take fees and blah, blah, blah. But like at the end of the day, my returns haven't changed that much from what I was getting on the single family stuff. But my time has drastically changed from having 0 time to having a lot of time. And that's the biggest benefit to me. That's kind of my message for anyone, you know, that finds me on whatever, Facebook or Instagram. I put out a lot on like this concept of time freedom, you freeing up your time. And so it's not black or white. It's not right or wrong. I mean, yes, there's a lot of money potentially to be had on the general partner side. Absolutely. But it's also, as you know, a lot of time commitment, a lot of stress, and a lot of all of that. And I just don't want that. So to answer your question, I continue to do the LP stuff. I hope to continue to do the LP stuff. I do not want to be a GP myself.
That's good. And as you can see, all the older, wiser people would say you don't get any more time back, right? So people don't realize that. So I think that's really important. So what are you doing with your time, baby? Yeah. What are you doing?
It's on the beach. What are you doing? Yeah. So here's what happened. So back to, just to reverse real quick, back to where I left the oil industry, right? And kind of I had my FI number, my financial independence number. So the first thing, I didn't know what to do, to be honest, but I knew that I had cash flow now to pay for my lifestyle expenses. So I thought, okay, well, I don't want to retire. Obviously, I'm young. So I went to go work for a brokerage firm. I wanted to learn stocks, bonds, mutual funds. I got licensed. I wanted to learn that stuff. But unfortunately, the way that that model's designed is there's not a lot of like personal investing knowledge that comes of it. It's mainly just teaching you about a firm's products and then go sell those to everybody. So I fell out of love with that, misalignment of interest. Then I started working for a small local syndication group. I started kind of building out part of their investor relations team, but mainly just to learn underwriting and acquisitions. And like, I wanted to be inside this business that I was investing in so I could learn a lot more about it. That led to working with Ashcroft Capital and Joe Fairless. Just, I met Joe, the criteria clicked, the deals clicked, everything we've talked about so far clicked, monthly, everything, transparency, great reporting. And so so last year, 2019, I joined forces with Ashcroft. It's kind of a funny story, but anyway, yeah. So I do that specifically for one reason. I have the time now to give back to others. I love to network. Okay. And so this was an outlet to stand behind a name, a brand, and to get exposure out there into the industry and to be able to attend conferences and to be able to reach people. And so that's what I do is I network kind of in an investor relations capacity, but I just try to add value where I can. And the majority of my phone calls that I have with folks are not the right fit, let's say, for Ashcroft Capital, whether they're not accredited or they're doing other things or whatever. But I just like to network and learn from others. I like to find new deals that way. I like to share books and knowledge and resources and stuff like that. So I give my time back, I guess, is the short of it, right? That's what I'm doing right now. Ask me in 5 years, I don't know, but I love what I do right now, and it's beneficial to me. So
now you guys, based on what you're saying, you just invest capital for yourself. Is that correct?
Yeah, that's right. Yeah.
And do you ever see yourself doing some kind of like fund of funds type of vehicle?
You're talking about me or Ashcroft?
Like for yourself, like
I
syndicating
see.
some money to invest in multiple funds.
Yeah, probably not. I like the individual deals. I've certainly invested in a handful of funds, and they have their pros and cons. But what I really like are the individual opportunities. This is one property in one place, one location. I can fly out there. I can go walk the units if I want. I like that. I like to do my due diligence that way because I understand that best. But that's just me. So doesn't make it right.
Now, one of the questions everyone always asks in today's world is, what's the tax liability, right, on different investments? And so do you have any strategies that you use when you're looking at deals or any things that you're looking for specifically?
Two of the things that changed the most in terms of taxes for me. One, I read Tom Wheelwright's book, Tax-Free Wealth. That was years ago. He's come out with a newer edition with the tax code change. That started my journey into understanding taxes in general when it comes to business and real estate and depreciation and all of that. So whether you pick up a book like that or however you find the content, I guess my point is find a fun way to kind of educate yourself and open that door. Because once you do, what that led to is switching CPAs now almost 3 times because I'm looking for a CPA that's an investor themselves, that knows a lot about real estate, that does all the same things I do to an extent. And so they're helping themselves, they're helping me, we're having the conversations in a very educated way. And I guess I just didn't realize that, I guess I just thought a CPA was a CPA, but it's just, man, it's just not created equal. So I pay a lot more these days to have my taxes done by a true professional, but they have pointed out so many things that I was not doing, so many things I could be doing, should I choose to. And so the combination between self-education and kind of having a mentor, let's call it that, a mentor or a coach, that's how I look at my CPA. And those have been the biggest things. Now, when it comes to being a passive investor in a limited partnership or an LLC, so you get a K-1 tax form once per year and everything's done for you. So the decision you have to make there is asking the questions up front to the sponsor. Do you do things like cost segregation studies, right? Are you, taking advantage of bonus depreciation and all these things, right? You have to ask those questions up front because if they don't, you're missing out on a huge amount of tax savings potentially. And so those are all of my partnerships in the real estate world. They all do cost segregation studies, which, just, I guess from a high level, obviously not a licensed CPA, please seek, professional advice from a tax professional. But that being said, cost seg is kind of like a lot of folks in the single family space, myself included. You'll take a buy and hold piece of real estate, right? It's the cost of the actual building minus the land, and you're depreciating that on a straight line schedule. So like 27.5 years, let's call it, depends on the type of real estate. But But it's just pro rata each year, right? But when you do these larger assets, you have so many things that have a shorter lifespan in them, like a ceiling fan or refrigerators, appliances, cabinetry, carpet, whatever, things that aren't actually the structure of the building or the land. Well, they have a shorter lifespan, maybe 3 years, maybe 5 years, maybe 7 years. And so you can capture that depreciation in a much tighter, condensed schedule, so that when you get your K-1 tax form, you have tremendous passive losses potentially in year 1, year 2, year 3, stuff like that. And again, not giving any legal advice, but check that stuff out. Cost segregation studies are a must if you're going to be a passive investor in larger assets. It may not make sense to pay to have one done if all you have is a single family home. You know, I mean, if you're cash flowing a couple $100 a month on one property and the study's $5,000, well, that knocks out your whole annual earnings, right? So that doesn't make any sense. So, but it is nice on the larger assets to pay for these studies and have everybody benefit from them. So kind of a long-winded answer, but there you go.
No, that was great. And I guess, have you seen a pretty big difference then in the amount you saved over the last 5 years?
I have. Yeah. Kind of leveraging those 3 things, right? Partnering with teams that are also interested in tax savings, finding a good CPA that kind of does what you do. By the way, not just on real estate topic, but I used to, when I worked in the oil field and I did overseas work, right? I was using the wrong CPA because, there's a lot of exemptions around earning your income solely in a foreign, country. Well, my CPA was just, straight lining it like anybody else, and man, I overpaid like tens of thousands of dollars in tax. It was crazy. And I had to go back and amend. It was a mess. But the point is, whatever you're doing, whether you're overseas oil field, whether you're real estate, and real estate's vague, as we talked about, what kind of real estate, these passive deals or active deals, vacation rentals, different stuff. Just find the most competent CPA that you can. And everyone will tell you they're the right fit, but really find out who's the right fit. Do your due diligence. It'll be worth the investment, in my opinion.
That basically means they aren't the cheapest.
That's true. That's true.
Right?
Yeah, it does. In my experience.
So what other goals or investing goals have you kind of set for yourself over the next 5 years?
Yeah, I'll continue the LP stuff. I've got a few mentors and folks in my network that have done a little over 100 LP deals, give or take. I mean, I really want to be on that path. I am on that path, but I want to get there on the path. So really, to me, that's the goal. It's not a specific number or anything. I don't have I've gotten where I want to be in terms of, paying for overhead, but I like the process. I really do. I just like real estate and I just like, networking. I just like partnering and doing this partnership stuff and having the choice to be hands-on or hands-off with it. So hopefully after COVID's over, my wife and I are international travelers. So we love just doing trips, just spontaneously wherever. She works for an airline too, by the way. But yeah, so hopefully more travel and, looking to start a family and more LP deals.
So from, the network or the mentors you've had, I mean, what has worked the best for you? Why has it been the best deal?
Out of my mentors?
Yeah, out of your mentors and or, the networks that you're involved in.
Yeah. Mm-hmm.
What are the great benefits that have come out of it?
Well, so I found one particular investment group that stood out more than the rest that was local. A lot of the local ones I haven't found a lot of success with. This particular one is about 400 accredited investors that meet once per month. And we just talk deals and investments. And usually there's a presenter. It's a pre-vetted individual that somebody in the group's been investing with for 10, 15, 20 years, things like that. I found a lot of deal flow out of a group like that over time. So that's been a huge benefit. Is like we talked about when I first got started, I didn't have deal flow. I didn't know who to talk to or where these deals were. So that was a great eye opener. As far as the mentors themselves, like individuals that are, 100 plus deals, just having the casual conversations have helped tremendously, because the beautiful thing about a mentor, a coach, or a Q&A call like I try to offer to folks is that you can nail down to your specifics, right? And like your specific individual questions that often aren't answered through a book. and may not be answered through, you know, a podcast or a movie or whatever it is. So it's nice to have that human, like, what, you know, let me pick your brain on this topic. If you were in my shoes here, what would you do? That kind of stuff goes a long way. So that's been the biggest benefit for me.
That's great. And so our final question is, what is the biggest takeaway for our listeners that you can provide from your experience in investing your capital, growing your wealth, and minimizing your tax bill?
It has been from self-education. And 2015 was my extreme year where I read 52 books and did all this crazy stuff. And that was probably overkill. But the fact is, to hone in, self-reflect a little bit. There's some great books too on kind of finding yourself and who you are and goal setting and all that kind of stuff. But additionally, just in the space that you have an interest in, real estate, you know, as a whole. So through that and books, like I mentioned, tax-free wealth and all that kind of stuff. I mean, just it's a numbers game is the problem. So most people only read 1 or 2 books a year max, right? But if you read 10 or 20, it's a numbers game. Every second or third or fourth book is going to have some great content usually, or a great takeaway that can be life-changing. So the fact is, you just have to embrace self-education, in my opinion. That's been the biggest thing that's helped.
No, I agree. I've been pretty much self-educating for life, I think.
Yeah. I felt like my education started after college, to be honest with you. Felt like I was just like boxed in on this conveyor belt thing. And then all of a sudden the doors open, and that was where my education started. So kind of funny.
That's great. And if people want to get a hold of you or reach out to you, what is the best way for someone to do that?
Sure. Yeah. So I mentioned the 15-minute Q&A call. I also have a downloadable PDF about what we're talking about. It's called Understanding Real Estate Private Placements. It's just a 20-pager with terminology, questions to ask a sponsor, how to vet operators, teams, and markets. So you can do either of those, the call or both, at ashcroftcapital.com/connect with Travis. And additionally, I'm on all the platforms out there, Instagram and Facebook, or at Passive Investor Tips. And then I'm on, you know, Bigger Pockets and LinkedIn, and you name it, I'm probably there. So definitely connect. Love to help in any way that I can, anybody who's listening. And I don't sell anything. So that's the good news. That's the rarity of it. So reach out.
Thanks, Travis. Thank you for coming on today.
All right. You bet, Joe. Thank you.
Hey, everyone. Thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.